Yeah, the debt ceiling didn't get any jokes at the White House dinner this weekend. No jokes about the debt ceiling.
No, it could.
No. Let's get the opening bell here in the CNBC Real-Time Exchange. And the big board, it's Quinnipiac Men's Ice Hockey celebrating its 2023 National Championship. Congratulations, guys.
There we go. Welcome aboard to another Course Member live stream. So what do we got today? Well, we got First Republic and its pain being ended by JP Morgan, who's going to buy them over time, little piece by piece. Quite interesting. Blackstone's real estate REIT limiting withdrawals for a 6 month in a row. This is not a surprise. Remember that in times of turmoil, people generally want their money to be liquid, so they remove money from things that are generally deemed to be illiquid. And real estate, especially if there's any exposure to commercial real estate, is something that people keep wanting to pull money out of. That's not a surprise. You've got otherwise probably the biggest news this week is going to be ultimately the Federal Reserve. Are we going to get that pause signaled or not? The Fed's meeting begins tomorrow, and we get the result on Wednesday. So we'll be covering that. Obviously, I'll be covering that live. In addition to that, we will have earnings this week. But I would say the Fed by far, are they going to wake up to the idea that, hey, maybe just maybe we've started over tightening or not? Are we going to get a Fed that is sort of apologetic for this over tightening crisis they put us through? Or are we getting a Fed that's unapologetic that, hey, we got to keep going? A lot of people bag on them, suggesting that, hey, they've over tightened. They're going too far. This is stupid. They're looking at lagging data. Even Elon Musk, he's like, I think I know more than any of these people with the data that I have at Twitter and SpaceX and Tesla. That's great, Elon, but the Fed has to consider people's inflation expectations. That's something Elon does not have to consider. Elon just has to look at the current state of the economy, the current state of inflation, not inflation expectations. Let's see, if you only look at the current state of the economy, you end up getting a 1980, where you end up having to Paul Volcker just 2 years later, right? So that's not necessarily the right answer, Mr. Elon, but that's okay. I'm not trying to be like a Fed apologist here. They've got plenty of their own problems. But the reality is, we don't know what the Fed's going to say on Wednesday. So we're excited. We'll see. We'll see what happens. Yes, Steve. I was thinking about you while I was interviewing Gordon. He's a gold guy. He's a big fan, and it was funny. He really wanted to dispel, which is fair, this idea that he's such a bear. He sort of lamented this before and after. He's like, man, I want to be bullish. I just think that the time that we're in is such that we have to see a price correction first, and in the meantime, we should be in gold. Yeah, exactly. Gold and nuclear. That's right. CPI consensus? I don't know. That's a little early. 12 days out. That's probably going to be a little weak. So you're not going to have most of the estimates yet, but I'll look. Any opinion on that the ERC you're talking about, right? The employee retention credit? Yeah, I remember covering this back in the stimulus days. If you had employees during the pandemic, I would 100% call them. I don't know anything about the company. But if somebody can make it easy for you as a consul and they don't get paid unless you get paid, I wouldn't even bother going to Google. I would just call them. Again, I don't know anything about the company. I never use them. I'm just saying, I'm just trying to put myself in the shoes of, somebody who's exhausted about the idea of sort of stimulus and really, there's going to be saying, I remember covering the ERC, and there is a credit for this. And everybody did forget about it. So I do I do agree with that. But let me look at CPI really quick, and then let me see what I can figure out. But I would probably just call, honestly. I lost brains as well. All right, CPI year over year flat. Expected to be at 5%. That's really interesting. It's actually from May 10th. Wow, with energy going up, CPI flat, CPI core expected to be 0.3. Month over month, though, non-core 0.4. It's a little hot, but core 0.3. Interesting. And then core year over year 5.4 down from 5.6. I mean, that's the estimate now. I'm going to say this is a light estimate, though. This is likely to change a lot. I don't know how many estimates we have yet. I can't see it yet here. Yeah. I would guess you still only have like 5 of the estimates in, so expect that to be volatile, but there's your starting point. All right. You didn't send a tag. Oh, yeah. Usually when I do the course stream right at like 6:25, 6:30, I've just tried to send people less alerts, honestly, because I don't know. I don't want to bother people. And I just figure if I'm going to do it on time, I may as well just not send an alert. Well, close to on time, within that 6:35 or 6:25 to 6:35 range. All right. Employee retention credit. All right. Let me see. Let's look at it together. Let's try to figure it out. All right. If I press. All right. Well, plug it in. All right. Let me see here. So, employee retention credit is refundable tax credit for businesses that continue to pay employees while the shutdown of the pandemic, who had declines in gross receipts from March 13, 2020 to December 2021. Wow. Declines in income between March 13th, 2020 to December 31. I remember, wasn't it like you had to have like a 25% decline? I remember this. You couldn't do this and PPP. And I remember Kevin O'Leary said this too. And then they let you do both, but it had to be at a different time, I think it was. Wow. That's incredible. I remember this. I might have to just do a full detailed video on this. Significant decline in gross receipts in 2020 or decline. Not significant decline in 2021. Oh, this is actually very interesting. Right, and you couldn't count the wages reported towards PPP. Fine. I mean, actually, it doesn't seem that difficult. Let me see here. Instructions. There are 3 sets of instructions. There's the 2020 instruction, 2021, and the start of 2021. Good Lord. 31-page form. Let me see here. Well, most of it is instructions. Oh. Yeah, if you had your payroll records, like your 941s and that, you could just fill this out. Yeah, this might be worth a separate video. This is a little tricky, but let me see what I can do. I'll look at that. I think it's very interesting. Claim for refund. I'll take a look at that. Let's see what we can figure out. I work my schedule around live streams, so it's good to know when it's happening. Yeah, the course member live, the core live, with the exception of like the end of last week when I was a little screwed up because of the traveling. The goal is 6:25. Worst case, it's before the bell, so it's like 6:29. That's my goal. I want to keep that as if there's one thing I do consistently, I want it to be that. That's my goal. If there's one thing we can pull off consistently, just let it be that. Everything else we'll have to figure out. So, all right, let's see what else we have. So I think SoFi reported earnings today. Let me look. Investor relations. JR says 12 months ago, April was 0.4 month over month, so flat year over year is normal. It doesn't count it that way. So it does the month over month is takes the nominal, the number, right? So the month over month is how much did you actually move from, like, say CPI is 301. How much did you actually move from 301 on a month over month basis to the next month? So, for example, if it's 301 and you multiply it by 1.004, you'd be at 302.2. Yeah. All right. So, SoFi down on triple B. Let's see here. SoFi reports results. Let's see what we got here. Let's throw that on the iPad. Be a little simpler. All right. Let's look at SoFi together and see what we got here. It's Monday morning. Let's get the juices flowing with a nice warm up. A warm up earnings. Oh, that sounds terrible. All right. Let me go to cash flow first. If they gave us a cash flow statement, they may not have. Condensed statement of cash flows. Okay. Condensed statement of cash flows. So what do we get? Operating activities. No. What? I mean, SoFi is an interesting one because we know they're a lender, but net cash used in operating activity, negative 2.2 mil, financing, 2.2 bill, financing nearly 3.4. So we took in some more financing, but cash position, because of that increase in financing, actually increased 1.1 bill. I'd like to see the detail of that, but let's actually then look at their earnings and loss. Let's see what we got over here. So loss per share, their loss was only 34 mil for the first 3 months of the year. Year over year, that's a significant improvement. A whole lot more loans in terms of interest income, which makes sense with not only the interest rates that we've seen, but the growth that the company has seen. You've got total interest expense. Let's see how their margin has moved, because remember, they got their banking charter, so we should see their margin improve. So if I do 135.5 divided by 371, I'm at about a 36% expense over here in interest. 36.5%. And previously that was, boy, they've just exploded, huh? 118412. That's very interesting. So I suppose this is because interest rates have gone up. But even with their banking charter, their gross margin has declined. Okay. Which is probably, again, because rates have gone up. So we'll give them that. What do we got in terms of non-interest expense here? So total net revenue, what do we have here? Non-interest income. These are other sources of income over here. So when we look for income, we're going to be looking at these numbers and these numbers. So this is sort of how much money they're making on the business, or sorry, on interest. This is how much money they're making on the business. Okay. And then here are your non-interest expenses. So these are the costs of operating the business right here. So we're still slightly negative here, but barely. Look at that. Only down to, we're at, what is that? Total non-interest expenses, 508 divided by 472. We're at 107.6%. 107.6%. That's their cost of goods sold here, right? That's how you get negative. Divided by 439. Yeah. 439,949 divided by 330,344. It was once 133%. 133%. So that's really narrowing, which is nice to see. Sales and marketing barely grew relative to how much they grew their loans. But then again, they're making less fees selling these loans. Look at that. Loan origination fees actually fell. Huh. I wouldn't have actually expected them to have any kind of decline. Yeah, that's a 20% decline in loan originations and sales. So that means they took an L on some of the loan book there. Minus 20% here. Servicing stayed roughly flat. Technology and product solutions, nice slow increase here. Other increase. But their biggest non-interest income segment fell 20%. I wonder why. I think that's interesting. Because why would you see loan originations? I mean, if you're originating loans at higher interest rates, you should be able to still make the same kind of money. Let me see. And then we'll look at their guide. But lending segment, higher loan balance. I don't know. Where's that originations? Personal loan originations. Oh, you know what it is? My guess is home loans give them more money than what's it called? Personal loans. My guess, personal loans make less money. Let's see. Yeah, look at that. Right here. Personal loans grew 46%. Student loans fell 47% and home loans fell 71%. So, I mean, how much could you charge for a personal loan? And I'm not talking interest here, right? I think that's what's going on. Like, somebody's not going to walk into a bank and be willing to pay, 10 grand like they will for a home loan, for a personal loan, but they'll pay $50 and then a higher interest rate. That's what's going on here, is you're screwing up the mix. I think that's what's happening. So my guess is they're ruining their mix. They're originating much more, but they're becoming that, dare I say, how would you call it? What they're becoming? Like that piggy bank lender for individuals versus more profitable home business lender. I think that might be a better way to put it. Yes, more interest, but cost of capital also up on that. All right. Okay. So, yeah, I mean, you can look at it here. Like the average balance of a personal loan is less than 1/10. It's an 11th of a home loan. And that makes sense. So how much are you going to charge for a personal home loan? I bet you don't even charge fees. SoFi personal home loan. SoFi personal home loans. No, not home improvement loan, you dum-dum. Personal loans. Personal loan. Here we go. See? Look at that. Get 5 to 100K in 60 seconds. No fees. No fees required. Oh, that's a little. No origination fees, no prepayment fees, no late fees. All right, well, there's your answer. So, yeah, that's exactly what they're doing. So, unfortunately, that's not necessarily a horrible thing, right? It just, let's see what that would mean. So, your amount of loans has gone to the moon. Yeah, but that non-interest income, that origination side falling, my guess, without looking, is that might be why the market spooked. The market could just be spooked all over. I don't know. I think everybody's just waiting for the Fed this week. Everything seems a little red right now. Let's see. Trying to teeter to positive. Okay, so let me see here. If I expect them to go positive this year, right? They've crimped their G&A. Their sales and marketing grew nominally. Their tech grew pretty decently. But the growth you're getting here feels solely based on the interest rate. So it makes you wonder what's going to happen when that goes in the opposite direction. And, there's the risk is like, what happens if people stop needing personal loans and then people still aren't borrowing for their businesses or homes? I mean, I suppose that would be a risk for any kind of lender. So that might be an extreme scenario. Let's just look at some more of the data they have. SoFi, one-stop shop for digital financial services, delivered another record quarter. Adjusted net revenue. What the hell is adjusted net revenue? I don't even want to read that. These percentages are nonsense. And I don't know what your adjusted net revenue. What is it? Refer to financial tables. I'm not referring to your financial tables. Anytime you hear adjusted, take it with a grain of salt. Adjusted is basically we're going to adjust the numbers to look the most desirable to us. It's fine. Every company does it. We added over 433,000 members. I mean, they are growing up with user growth or blowing up with user growth. I wonder if that's not on pace with what people are hoping for, though. Maybe people were looking for a bigger user growth number, and then that mix wasn't great. All right, they keep talking about adding all these products. Nobody cares. We want money. Total deposits, fine. For new direct deposit accounts, the median FICO score was 749. That's fantastic. Okay. Yeah, I mean, people really seem to like SoFi. Like, don't get me wrong. I don't want to be anti-SoFi here. I think they're cool. Like, I want to use SoFi. I think they're like I think they're pretty good. Anyway, so I'm just trying to understand what's going on with the financials. Okay, here's the member growth. All right. You know what we're going to do? Let's try something here. Let's see here. Calculate the growth between... Well, I guess I could do this in a spreadsheet too. I don't want to calculate the growth between these numbers manually for each number because then I have to write them like twice as many times. So I'm just throwing them in the chat GPT. I could just throw them in the spreadsheet too. But honestly, that was not bad. Let me see. As a percentage month over month. Okay, yeah, there we go. So this was a month over month, 11.66 to, oh, that's between these two right here. Between these two, 9.82. Between these two, 10.12. Between these two, 8.29. Well, that's convenient. Okay. Which annualized, 8.29 annualized. What is that? That's like 30 something, right? 32-ish, a little more than 32. Yeah, 33.16 annualized. That could be why too. So potentially slower user growth than expected for an annualized rate, but then also that fall in originations. Technology to underwrite, macro headwinds. Okay. Technology revenues over here. This is like their stock segment, right? Where they allow you to invest in stocks. There's no money to be made in that. Okay. What's the expectation? Management expects, this is the expectation for adjusted net revenue in the second quarter. Well, what was it this time? And I have to figure out what that is anyway. But their adjusted net revenue here was, oh, well, there you go. So Q1 they had 460, and now they're guiding like no growth. They're guiding 475 at the midpoint. That's 3.2% growth. So my guess is the following. Problems. User growth falling to 33%. Guiding to only 3.2% month over month revenue growth, and mix going less profitable. These are the problems that I see without having been spoiled by the internet yet. All right. Now I'm going to get spoiled by the internet. The SoFi earnings. News. Um, 2 hours ago. Business Wire. This is behind a paywall. I'm going to vomit. No, this is just the press release. Okay, somebody's got to give me the actual rundown of this sucker. Let's try over here. I like comparing to what I say over here. Okay, so SoFi remains optimistic. Profitability is close by the is potential by the end of the year. SoFi suing the Biden administration for the loan payment loss or a pause, the student loan payment pause. This is nonsense. Okay, let me look over here. Do it the old-fashioned way. SoFi to be bought by another bank. That's possible. How much is this sucker? SoFi stock. What? Few bill? 5.4 billies. All right. Let's see what the problem is. So, fiscal year adjusted net revenue guide or estimate versus actual, that was okay. Fiscal year EBITDA, that was in line. They reported less of a loss than expected. Yeah, that's interesting. They are beating on the quarter estimates. My only guess could be, and there's not a lot of coverage for SoFi, surprisingly. There's surprisingly very little coverage. Yeah, my only guess right now could be those problems that I outlined, but otherwise, and the fact that you're losing money, but hopefully that changes. The other thing would be what's happening with that cash flow, because they increased their cash position through financing, which is fine. They are a bank after all. Where's that balance sheet? Here it is. Oh yeah, this is how they come up with adjusted. That's adjusted EBITDA. I was going to look at adjusted net revenue. Oh, here it is. Oh, it's pretty similar. That's not that big of an adjustment. See, their adjusted net revenue is they just add their the change in servicing rights to their adjusted net revenue, which is a market fluctuation. Fine. Okay, what do we have here? So, balance sheet. They propped up their cash. So they didn't give us a full cash flow statement, but we could look at debt and see if debt got propped up, unless they had more deposits. No, they took on more debt. See that? Let me make sure the columns are right. Yeah, 2023 versus 2022. Right here, you can see they increased their debt about $600 million. I wonder why. Now, they did increase their deposits quite a bit. So why do they, if their deposits went up nearly $3 billion, why did they have to increase their debt $600 million? And they also, let me see here. They also created some more shares, about 7 million more shares. That's relatively nominal. Goodwill stayed the same, servicing rights down, loans available for sale, fine, deposits, fine. Yeah, that's interesting. And they borrowed another 600 mil. I'm going to write that down in my little summary. Deposits. So what was it? Deposits grew 2.7 bill, but borrowed another 600 mil. So what's our debt position now? It could be the banking crisis, quite frankly, what's dragging them down. Because they've got 6.1 billion in debt. What's their equity? Equity's 5.2, which is close to what the market values them at. Based on what these loans are worth, loans available for sale here. But the value of those plummets if the market gets worse, right? So another issue. Oh, this is an interesting skepticism. I'm not sure about this, but what if? And again, I don't know. But it would be a question that I have. What if it's harder for them to sell their loans available for sale right now? So yes, they're creating more loans and getting more interest income, but they're not as easily able to sell their loans. Therefore, they're holding more of these now more personal loans on the books, which increases the risk of those loans being worth less as a risk to SoFi. That is, defaults more likely on personal loans than on home loans. Right? What's your typical default rate? Let's ask ChatGPT. Compare the typical or historical default rate on a personal loan versus a home loan. I'm just gonna guess. Before this pings, I'm gonna guess default rate on a home loan's probably 2%, 2%, somewhere around there. Default rate on a personal loan's probably like twice that, 4 or 5%. I don't know. Let's see here. Holy shit. Personal loans 3.5%. Meanwhile, homes were around 2.1%. All right. That's pretty cool. Yeah, but that's based on 2021, right? So historically, personal loans about what is that? 3.5. That's about 1.6x times as likely to default. But in a recession, maybe 4 to 5 times as likely to default. There's no leftover equity, right? In a home, there's equity. Anyway, so much of SoFi's equity, much of this company's value right now is in loans available for sale. Let me show you where you can see that. Watch this. Go over here to their balance sheet and then go all the way to the bottom. And I want you to look at this line right here. It says total equity, right? 5.2 billion. What's the stock trading for? $5.4 billion. So it's trading close to its book balance sheet equity, right? So 5.4 billion market cap, 5.2 equity. What's the assumption as to why these would be closing so close to each other? Well, what is the most valuable asset they have? Really, the most valuable asset they have is, they've got some cash, but the most valuable asset they really have is that right there. Loans available for sale minus cash that they have to pay people, which would be your deposits, which is actually, wow, Wait a sec. Yeah, look at that. Total deposits are $10 billion. They only have 2.5 of that in cash, right? Which I guess that's decent. 25%, right? About 25% of that's it actually seems decent initially. That seems decent, right? About 25% of deposits in cash. But wait a minute. That assumes that these loans can actually be sold for these values. Let's see here. So let's do this the Kevin way. Let's call it 2.5 bill in cash. We've got, and we'll say in related securities, I'll round that to that. Securities. Then we have loans of 15.8 in loans. Loans held for investment, whatever. Call it 16 billion in loans. We're doing this the Kevin way. I don't care about servicing rights, property, goodwill, intangibles. None of that matters to me at all. What I know is that you've got $10 billion in deposit debt, because that's a liability. You've got $6.1 billion in other debt. And then you have bills of $600 million. 0.6 bill in other bills. Okay, so now we do the Kevin analysis here, the Kevin stress test. 16 plus 2.8, you got 18.8 minus 10 minus if there's a banking crisis. But that assumes you have to sell all your loans, which you're not going to be able to. So you got a buffer. Buffer at this bank is 2.1 billion. However, that goes negative if loans held for sale falls how much? 2.1 divided by 15.8 is 13%. So if loans available for sale lose 13% of their value, the bank has zero equity. Basically all value is gone. They don't actually really have 5.2 in equity because that's propped up by 1.6 billion in goodwill, some of these other assets and servicing rights and all this other nonsense. So if I look at it just from a straight cash versus debt point of view, they got a $2.1 billion buffer, which is gone if their loans held for sale falls 13%. Now, there's no mark to market for that. Oh, is there? Oh, yeah, it does say at fair value. Okay. All right. Let me look at the annual report to fact check that. SoFi, which is good. As if it's based on today's valuation, that's okay. It would just mean there's some risk if in the future that had to be its valuation had to be adjusted. Loans available, and I wonder if people are actually still buying these. Oh, please use. Why is Command F not working? I really don't want to go through 220 pages here. I want to do a few more questions. All right, 1 second, then we'll do questions. I think SoFi is falling on a symptom of the banking crisis. All right. Loans available for sale. No, not available for sale securities. Oh, good Lord. Of course, Command F is not going to work. Why would it? It's fine. I could find it without cheating. I will find you. I just need to go to their balance sheet. And then the definitions after the balance sheet. That's the income statement. I'll switch the screen in a sec. I just don't want to give people epilepsy from all this paging. Ugh. Liquidity, sources of funding, borrowings, covenants, guarantees. I don't care. I want one thing. Fair value. Ugh. Fair value is defined by the price that would be received for an asset, an exit price, in principle, or most advantageous market in the principal or most entities in the principal. An orderly transaction between market trends on the measurement date. 3-level fair value hierarchy to disclose. Quoted prices for similar or identical observable input prices. All right. I mean, assuming these loans are liquid, they're basically looking at Zillow and going, well, that's what everything else is selling for, so our loan should be worth this. And then they apply some kind of DCF to the longer term loans. That's fair. I think that's okay. I'm not going to judge how they determine these loans available for sale, but I will say they don't have to be wrong by a lot to be negative. So that's potentially some of the pain that you're seeing. Not sure, but that's my guess. All right. How's that for SoFi? I think we did good. Still working on lows. Let me edit in that we did that. SoFi earnings. Gordon has you nervous about your Tesla position? Honestly, like, I enjoyed meeting Gordon. He's a nice guy. I really enjoyed meeting him. Very nice guy. I don't think he's evil. I don't think he has a really bad blood or whatever. But his arguments on why Tesla sucks made me more bullish on Tesla, because I thought to myself, if these are the arguments the biggest Tesla bear has, and this is A, nothing I haven't heard before, and B, not scary. So that's why I wanted to meet the biggest bear. I'm like, well, let me see if the biggest bear knows something I don't know. And he had some good perspectives on, like, I liked his, like, Fed courage thing. I kind of disagree with him. I think the Fed is realized they effed up once, and now they're going to be very courageous. But we'll see. Yeah, we'll have to do a Cloudflare analysis. I thought that was very interesting, the Cloudflare stock. We'll have to save that for the next day, though. People have spoken about a second wave of inflation. I really don't see that. Where do you see the second wave of inflation? Housing market affects SoFi a lot. Well, yeah. They purchased Wyndham Mortgage. Yeah, I saw a note about that. I skipped past that. No late fees begging for defaults. It's potentially true too. It's a good point. When's the next HA? Yeah, I don't know. But whenever I posted it, have you not seen I still have a 420 banner up here? I got a little catching up to do. Yeah, I was so dead this weekend. I think I got sick from too much back to back travel, because it was like York, Chicago, North Carolina, and I don't know, it was just a lot. And then obviously Cali. Yeah, but usually I don't have an issue with that. That was a little, I don't know. Anyway, getting straight in that today. Raw materials second wave will come after deflation. Look at the 40s. You want me to look at the 1940s when we were in war? Like World War? Did he take GM's money? I don't know that he is, like, bought out by GM or something. I think then maybe his argument would be better. Seemed like he was holding back. I don't think I was holding back. I think the thing is, you have to be respectful in an interview. Otherwise, who's going to invite you into their home? Like I said, I like the guy. I think I enjoyed his perspective, and I think everybody deserves their opportunity to share their opinion. I'm allowed to have a different opinion than them, you know? That doesn't mean you have to be mean. I mean, I feel like I could do an interview with Mitch McConnell and AOC and not make them feel bad, you know? That's the point. So yeah, you have to be careful how you respond in interviews. Yeah, his POV on solar wasn't bad. Make AOC feel bad. Look at how much money and resources are going to Ukraine. Yeah, that's true. We were spending some pretty pennies over there. Yeah, I didn't have my Tesla there. It sounds like he refuses to get in a Tesla. Anchorman doesn't give you his opinion. I like that. All right, I gotta go. Stay tuned, and we'll see you tomorrow. Goodbye.